Okay, good afternoon, everybody. Welcome to the weekly Take on the Market. This is our first Take on the Market for January of 2023, or the first one for the whole year of 2023. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. I can't provide buy, sell, hold recommendations, strategy, advice on what you should do. I do have a lot of experience in the markets. That's both good and bad, but I've been trading my own account since 1995. And one of the great perks of this job is being involved in the markets. Most, if not all of my colleagues have skin in the game, so to speak. So we're right there with you through thick and thin, the good and the bad. Okay. So we'll get into my market thoughts for the week. We'll do the usual routine stocks to watch, industry groups, some random thoughts that I have that I've pulled from Twitter or whatever it might be, and then the quote of the week. So let's start with the market. And you should see a chart of the NASDAQ. And let's go backwards just a little bit. So January 1 of last year, I think was like the high or something, especially for the S&P, but it's basically somewhere right in there. So, wave down, wave up, wave down, wave up, wave down, wave up, wave down. An actual, for lack of a better term, tradable rally. This was a pretty good rally off the lows. And then, it got pushed back. And, the straw for last year that stirred the drink was interest rates. So here's, this is January 4th of 2022. And this is the reverse of the 10-year note. So this is the interest rate, and it's breaking out of this base, ran out, pulled back, and trended pretty good, like almost exactly the opposite of stocks all year. And so there was a lot of talk last year being one of the worst years in stock market history. Not necessarily from just the sheer index pullback, but if you were in individual stocks and didn't have a sell strategy, you probably had a tough year. If you had some kind of mixture of bonds and stocks, probably had a tough year as well. So the old 60-40 didn't work last year like it might have in previous years, where like in 2000, when the market topped, the stocks went down, but bonds went up. I remember first time being kind of aware of, buying bonds in 2000. I think the rates went from like 6 to, I don't think it was quite, as low as we ever got in recently, but 6 to 3 or something like that. And so you had a, really big rally in bonds, which would have saved your bacon a little bit in some type of mixture. But last year was just, probably one of those, probably since 2008, I would say was, the worst year when you combine indexes, individual stocks, and, asset allocation, so to speak. The S&P held up a little bit better. I don't remember. I wrote down the raw numbers because I was comparing my performance to the indexes when I did my end of year review. I think NASDAQ was down 33%, S&P down 19 or something as far as like a year to date type move. Don't quote me on it, but something along those lines. Bottom line is the S&P held up a little bit better than the NASDAQ. If we fast forward to today, we had another important number, I guess the jobs number that the Fed will watch. And it seems like we just keep getting these numbers, like CPI and CPI and Fed job numbers, et cetera. So I'll be glad when the market kind of starts discounting the what the Fed's going to do and just kind of forget about that. But you had a pretty good day in the market today. NASDAQ was up. Now it's 115. So this might not be exactly right. NASDAQ was up around 2.5% today. I guess if this was the low 1, 2, 3, 4, 5, 6, I guess you'd have, a day 6 follow through day, for whatever it's worth. It's neither here nor there. I put a lot more weight in individual stocks, my portfolio. Am I making progress buying stocks? Am I getting run over being short stocks? That's a good signal too, that maybe I'm on the wrong side. These are things that I find more valuable than the indexes lately. It's something that I've gravitated to in the last few years because the indexes have gotten really tough and they're easily manipulated, I think. Many years ago, IBD stopped using the Dow as a signal for the follow through day and system. And that's because Bill felt like it's just too easy to manipulate 30 stocks, jump it all around. And I just feel like maybe these indexes have gotten with the prevalence of futures and options, which we'll talk about, I think, a little bit, but I've now started to hear more and more about these, zero dated options that expire in a single day. It's like betting on a football game. And it's just exacerbating the moves each day. And so there's just a lot of noise versus signal in the index, in my humble opinion. So today in the S&P had probably a pretty good day as well. Let's see, it's up 2.28%. I have noticed that I feel like international, and I've harped on this before and been wrong for a long, long time. So keep that in mind. But this looks very good to me. This, if this was the NASDAQ or the S&P, that just looks so much stronger. See how you just have a series of lower lows, lower lows, lower lows, and just kind of like, almost just like give up. I know this is it doesn't look like that much, but it's about, 17% down. So you have, 17, 17, 7, it's just, just kind of wears you out. And it looks more rounded. It's more uniform. See how it runs up and then a nice little correction. And then it just seems more rounded and more constructive price action. Now a lot of this is with like the Chinese market, which this is a double off the low, 17 to 34, and there's a weighting in emerging markets. Obviously, I can't off the top of my head tell you what Chinese weighting is, but I think it's relatively high versus other countries. But this just looks very constructive. Now, it hasn't done a lot for a long, long time. There's the weekly, there's the monthly, which is both good and bad. It's super appealing to me that it hasn't done anything for a long, long time, because if it did start to do something, I think your runway would be massive. But it hasn't, it's like a stock. I want a stock that's shown me it can make a big move before I'll buy it. And it's kind of like the same thing with some of these indexes. So I do not own EEM, even though I could see, I could make a case for owning it. I do own DTH though, which has a little bit bigger yield than emerging markets than EEM. I think EEM is roughly 1.8 if I recall. Oh, it's 2.4. But this is much larger, a little bit more value-oriented positions in this one versus EEM, and I feel like the market's shifted into those types of stocks at this very moment anyways. But look, you're coming out of this huge potential cup with handle, and this looks more rounded. I've owned this for a while. To me it looked like a double bottom, but a great day today. Is up 2.3%. And I think, yes, little clues that you see, like the NASDAQ, I think was down yesterday, was down 1.5%. And I was short the NASDAQ and long DTH, almost equal weight, almost. And DTH was only down 0.5%, right? So it's just makes it easy to hold, like, when and I'm using the QQQ, but like this day, the Qs were up 0.4 and DTH was up 1%. See, is like almost, it ain't going to be perfect. That would just be too easy. But it's just really exhibiting unusual relative strength versus the US market. So that's very interesting to me if you're looking for exposure. So, today was, from an index standpoint, I don't know if IBD is going to go to some type of follow through day or not. You probably want to understand the follow through day system, but it's one of the tools in your toolbox that you're using to make decisions. Is there anything else? What did bonds do? Let me get let's go to TLT, and this is the proxy for, long bond, and, had a pretty good day. So maybe the market's hopeful that the Fed is, that they're, the interest rate hikes was the word I was looking for, 0.75%, 0.5%, or in the rearview mirror. So I found it interesting that last year, look, and this is typical, unfortunately, but this is based on history, kind of how all works. The money rushes in when things are good, and it rushes out when things are bad. We're all human. We all kind of are subject to these emotions. Fidelity, excuse me, did a study on the performance of Peter Lynch's fund, the Magellan Fund, and I feel like I've mentioned this before, but if his average performance was 15%, the average performance of the average client was, less, 9% or something, because the money rushed in when it was good and rushed out when it was bad. And I found it interesting that last year, so in 2020, let's step back a little bit. You can see the net purchases, 2014, 2016, 2018. But in 2020, huge spike comparatively. And that's what normally happens, right? Markets were crazy good in 2020, especially after March. And the money rushed in. That's typical of what I would see. 2021 was kind of a stealth bear market. The average stock bear market started in 2021, but the indexes didn't top, especially like the S&P, until late 2021. But money came in 2021, even larger than 2020. But last year, I think most people were fully aware that it wasn't a good market, and yet money just kept coming in, which is very unusual. And it's just partly probably why it wasn't a great market. I don't know what it is, retail money, but and it's just more of an extreme when you're seeing extremes. So like if you saw extreme outflows, that would be probably a good sign for a change to the upside. But I just found this very interesting, that even though it was a lousy year last year, that people are in the mindset of buy the dip, because it works every time but one. And I don't think, based on that chart I showed you guys, that buy the dip from an index standpoint, and probably not from an individual stock standpoint, worked at all last year. Here is, I like magazine covers. I'll save them when I see things that I feel like are, like the Time Man of the Year, Elon Musk, Bezos. It's almost uncanny how these stadium namings, it's uncanny how that works. There have been more names of stadiums of companies that went out of business than you could believe. You do a Google search. The New England Patriots used to play at CMGI Field. That was a huge internet incubator in the 90s. It went away. Enron Field, the Houston Astros. Enron's gone. So these types of things that they don't. And the reason I want to show you this is that they're not going to ring the bell at the top, but they ring it very, very close. When you see these things, this is why you want to be kind of a student of history and observing everything around you, that you become aware and you know that you're getting close. And this was May of 2021, where I highlighted this monthly chart of ARK. And that's when this, excuse me, this magazine came out with Kathy Wood, the portfolio manager of ARK, on the cover. And she's the believer, right? She believes in Bitcoin and CRISPR and Tesla and all of that. And she might be right. You know, a lot of this technology won't go away, and it will benefit mankind. But you know, like CRISPR genetics, for example, but you might be down to maybe 1 or 2 or 3 companies that actually end up surviving and making money in that area versus the hundreds that come and go. It's kind of like the railroads. I don't remember how many railroads existed in the early century. Hundreds of them, I would guess, and very few of them survived to continue. Most of them went bankrupt and went away. But we still have the railroads, and we still benefit from having all of that railroad infrastructure built out. So, you know, when you see things like this, you should become a little wary and based on history. Options. It's interesting how options have become kind of the go-to, and maybe a lot of that money, that the retail money, is going to options. I don't know. It's hard to know. I don't do very much in options. I've just found them to be difficult because you can get the stock right and still lose in the option, which is just that's no fun, you know, if you get the timing wrong or if you overpay for the option. So, but I'm studying them, trying to figure out, you know, is there some place where I could get an edge in that? That's something I could do in them. But the amount of options that are trading nowadays is incredible, just stratospheric. And, you know, the new thing is the zero expiration options, which is just even more crazy to me. But, you know, look at this chart. This looks, you know, incredibly parabolic. And I don't know what the stat is. I remember when I got in the business, they used to say that 90% of the options expired worthless. I don't know if it's still that high, but even if it's not that high, it's probably, let's say it's 80%. So, you know, most of them are expiring worthless. All right. So yeah, this chart I should have done previously, but it's just nobody is invested in overseas international stocks as a general rule. You know, we have what they call home country bias, and luckily for us, the home country bias has benefited us because the U.S. market's been the best market, you know, in my lifetime, and probably, you know, 2 out of 3 lifetimes. But that doesn't mean it has to be the best going forward. Now, I would like to see some kind of outperformance, and, you know, maybe I'll pull up the comparison chart and use DTH and EM, and you can, you know, see if they start to outperform. But it's an uncharted territory, so to speak. Most people don't have exposure to foreign stocks. All right, let's pull up the industry groups. Number 1, retail, wholesale, office supplies. It's one stock in there, so probably should do something with that group. I mean, there must be a way to dump that into another group or something. I think there used to be 3 or 4 stocks, and just slowly dwindled down to nothing. Oil and gas field services still hanging in there. That's like Tidewater, Schlumberger. Retail apparel, shoes, Crocs, Nike. Department stores, commercial services, leasing. I can't think of any stocks off the top of my head. Maybe McGrath. I think McGrath broke out today. Apparel, shoes related. oil and gas drilling, medical hospitals, machinery, construction, mining. That's like Tex is interesting. It's holding up pretty good, building a base. But the main thing here is in the last kind of 3 to 6 weeks, or let's say more like 6 to 8 weeks, this has really changed, right? You see kind of this constituents is changing. Yeah, leisure gaming is new, insurance, life, steel producers, they've kind of been in there, but look at gold is starting to improve. Mining, gold, silver is number 23 group. Gold is crazy. It's like feast or famine. It's either the number 1 group or the number 197. It seems it's always like it's so weird the way it does that, but it's like 191 3 months ago. So I don't know. There's not a whole lot to make of this. It's not really a whole lot of growth oriented groups, but do some work if there's something that you're like commercial services, leasing. I don't know off the top of my head any stocks in this group, and I like to at least know 1 or 2 like go-to stocks in almost every group. So that's something that I would look at this weekend. All right, let's go back to Marcus Smith. We'll do some stocks. And I did the 2 ETFs that I want to talk about, EEM and DTH. So today was an interesting day. And David Ryan was on IBD Live for just a few minutes. He chimed in and talked about, some stocks breaking out of big bases. And I thought it was interesting because a lot of these stocks showed up on my radar. And it's just because that they're showing up on the relative strength screens. I apologize. I've been getting over a cold and I can't kick this cough completely. But BHP building this really big cup. Now it did that last time and didn't really make any progress. You can see the relative strength line is a new high. Pays a really good dividend. There aren't really a whole lot here, but there's a lot here. If that's enough for you, like it is for me, I do own BHP. I can go with that. I'd obviously rather the moons are aligned with this and this, but maybe the market is anticipating a change. The group is pretty strong, 28. So BHP and Rio, they all kind of look the same. Look at Rio, looks very much the same, right? Broke out of a previous base, built a whole nother cup of handle, very similar. Has a yield. This ain't all that great. I do own Rio as well. I don't know if you need to own both. Honestly, I think I'm either going to win in both or lose in both. It's unlikely one would go up while the other goes down, just based on the macro of the businesses that they're in. But it just feels a little bit like more diversified, I guess. Maybe it makes me feel a little bit better about that. So metal mining and ores, I know Vale, I do not own that one, Vale, but that's holding up pretty well too. So it's an interesting group that's kind of showed up on my recent radar. Today you had AEHR gap up on earnings. Let me turn off my camera so you guys can see the chart a little bit better, just in case. And at one point, it did finish up 32% for the day. Oh my gosh. So that means at one point it was up a lot more. That's incredible action. I don't own this one and had no interest in considering it. But I don't know. There's something to be said for that type of action. So that's really kind of a radar. And I think ACLS, which is a stock I have owned, had a pretty good day today too, probably on the backbone of AEHR's earnings, up 6%. And ASML, which is one that I like, he had a nice little bounce off the 50-day. So the group, semiconductor equipment, 25, I'd like to see something in that group that would really help the bull case, I think, when you have growthier type stocks to buy. That would definitely help the bull case. And just, just my 2 cents here on the earnings. Now, I didn't own AEHR into earnings. It wasn't on my radar. I probably wouldn't own something doing that, regardless of whether it was into earnings or not. But the thing about earnings is a lot of people are afraid of earnings, and I guess rightfully so. It's I'm going to get on my soapbox here for a little bit about this. So I'm going to go off on a tangent, but it came up because of the AHR. And I've had some bad days on earnings, but I've had some amazing days on earnings. And Jim Ropel, says, if you're going to have a big winner, like a true market leader, if you're going to have something that doubles or triples, you've got to sit through, like, I think he says, like 8, quarters of beat and raise guidance, and it's just, I don't know if 8 is the right number, but let's just pretend for a single year, if you're going to hold it for a year, the average big winner, and I'm no good at this, so take it for what it's worth, but the model book studies are, 12, 18 months for the stock to really, make its whole move. So that means you have to hold something for a while. I'm trying to get better at it, but it is what it is. To capture most of the move, you're going to have to sit through 1, 2, 3, 4, 5 quarterly earnings reports. And if you're afraid of earnings, you're never going to be there when it happens. And unfortunately, they're not going to let you sell on the day before and buy back in the day after. And I can't remember when it was with NVIDIA, but I just made a huge mistake in NVIDIA in my account, in my account at William O'Neill, running company money, because of earnings. I was afraid of earnings, and I was in NVIDIA somewhere here, and the old 10% cushion into earnings or whatever, and I didn't have much of a cushion, and I was afraid of the earnings. And let's see what the market was doing at that time. So the market was coming in, and guess what? The earnings were fabulous. The stock was up 20%. Oh my gosh, 29% that day. I remember I feel like it was up 20% immediately, which is why that number's in my head. And I couldn't bring myself to buy. I guess I could have just bought it, up 20%, but it was just so difficult for me to buy it. I had it at 66 one day, up 3 or 4 points, and I just couldn't pay 80 for it the next. And, then it went on this really long run, and I was shut out. And some of my colleagues at Wimley, they were in there. So, I was like, oh, it's serious FOMO. And then this felt very climactic this day. I remember thinking, oh, good. It's a climax top. Let's hope it's done. And it was done for half a moment. And you could see how it was just so much more difficult to buy versus if I have it there. Look, this is not easy to sit through, these little shakeouts. But when, if I buy it here and, I pyramid, I take my pyramid up to 83. At some point, I've got a 10-point cushion, and then I probably get shaken out here. And then I buy it back here and I pyramid, and then I get shaken out here. And you can see how, when you're in there and you have a good cost basis, you have a chance. And it's, this turned out to be one of the great winners of this cycle. Oops, I went back too far. And that's where I bought it. And there's the gap, right? And this is 60, 120, 180, it's a triple. And it would have, think about if a 10, 12, 15% position in your account that triples. So the moral of the story is, I think anyways, you can't, if you like a company, if you have it, you can't really worry about earnings if you're going to have a big winner. And maybe you could in hindsight, what I should have done if I had 5,000 shares, I should have taken it to 2,200 shares or 1,800 shares or something. Whereas I keep some of it, and that way I maybe I had a chance to buy that back. So earnings are hard for sure, but I just think you have to kind of decide how you're going to handle them, and you take the good with the bad. I know that I don't know if Xilinx exists anymore because it got bought out, but I had Xilinx and had a 20% gain in the account, and it gapped down one day and was on earnings, and it was all gone. And that was no fun. So that kind of, you think about those, and so you get out of the Nvidia. So, well, Nvidia would have more than paid for the give back in Xilinx. So, think about how you're going to handle earnings. But I think if you plan to own big winners and try to own some big winners, you're going to have to learn to sit through the earnings report, at least with some type of position size. And AEHR was up big on earnings today. ALGM, it's just in different group, but same sector, I guess, is setting up nice. I feel like back to Jim Ropel, he mentioned this stock on the IBD podcast, but you've got potential buy point, huge cup with handle, very big, unusual, of course, but we're in an unusual market environment. And then the oil and gas. So here's Valaris. It's building a base, and it's not symmetrical, of course, but this has gone down from 70 to 65, and in that same time frame, oil's gone from 130 to 75 today, I think. So it's held up fairly well, and it's got this really nice base on base pattern, which I like these base on base patterns. So you have a base that breaks out, tries to go up, market's not good. Imagine if this was oil, not good either, and stock just comes down and sits kind of on top of that base. I do own VAL for disclosure purposes. So there are names out there, Schlumberger. Now maybe they're not in groups that you like or prefer. You have to decide, you want to trade the market that we have or the market that you want. And I think the old leaders, if you find yourself gravitating to, Apple, Google, Tesla, MongoDB, Twilio, Shopify, they can go up in certain parts, but they're not going to lead us in the next cycle. Now, I don't know if the next cycle of leadership is going to be mining stocks and oil and gas stocks. I don't know. That's part of the problem with this market is I don't feel like there's any clear leadership, but it's going to be new. The leadership is going to be new based on history. So that takes me to, is there any other stocks? No. The quote of the week. And I was listening to a podcast, Mike Wilson, he's U.S. equity strategist, Morgan Stanley. And I don't remember if they were talking about Apple or Tesla or whatever, but one of the hosts says, forget about where it was. Because where a stock used to be has nothing to do with what it's quote unquote worth. I see that a lot on Twitter. I think that's how a lot of people have gotten themselves trapped into a stock like Tesla. Oh, let me pull up Tesla before we go. What order should I go in here? Here, pretend you didn't. Let's go to Tesla, because another thing I mentioned earlier and I forgot is the action in the market. So Tesla had they cut prices in China last night, and the stock gapped down. I don't know, in the pre-market, I think it was down almost 10. Because I was doing the math on my short, and down, I was doing the math at down 10, and it closed up today. So, and luckily I did, anytime the stock gaps down, I tend to cover, if not all of it, definitely some of it. So it didn't hurt me today, but this type of action, I have to listen to this. I think Tesla's short still and going lower, but look, Scott, you had bad news and the stock didn't go down. And so this is, the first kind of sign that it's washed out a little bit to downsides. That's another good sign potentially for the overall market. When stocks stop going down on bad news. Now, that doesn't mean I'm going to go long Tesla, a long way from that, but it allowed me to be more aggressive to the long side in other names, and it would get me to want to cover my shorts a little quicker in not only Tesla but anything else that I might be short at the time. Okay, sorry I took you off track there, but I wanted to talk about that action in Tesla today. And if you look at TSLQ, which is what I've, the ETF I've been in for my cash accounts, because I cannot short Tesla in a cash account like an IRA or a Roth. If this was a stock, that I was long, that looks pretty toppy. It's made a big move. You had your first break, try to make a new high, and then your second break. So at best case, if this was a stock I was long, I would think it needs a base. It needs sideways action. So the little clues that you can get from the overall market, even if you don't happen to be in Tesla or short Tesla or whatever. All right. So forget about where it was. And Mike says, just because the stock is down 50 doesn't mean it can't go down another 50. That's the magic of math. These cannot be the winners in the next upcycle. So they were really talking about the big cap tech, which is kind of the same thing that I feel until proven otherwise. I think Microsoft, Apple, Tesla, Google, et cetera, are avoids. They're just not going to be the next winners of the next upcycle. That's not the way it ever works, he says. They're too big. The economies of scale. How fast can an Amazon or a Google or an Apple grow when they get to 5, 6, 7, 800 billion in market cap? B, they've had their day in the sun. So their macro tailwinds, where the free money era, where everything is just perfect for them, and they just ride the wave. That day has come and gone. They've over-earned. The multiple got out of whack. It has nothing to do with the Fed, by the way. That happens in every cycle. The former winners can't be the next winners. I guess there could be an exception to every rule, and I think Bill would say that 3 out of 4 will falter, which means 1 out of 4 will participate in the next cycle. But I don't like those odds. It's hard enough to find a big winner, let alone find a big winner in an area where only 1 out of 4 is going to participate. So you want to be looking for new leadership, and that's the best way. And so screens, relative strength, RS line new high, earnings gaps, maybe AEHR is on its way to doing something great. These are things that should be showing up on your radar when you're doing your work on your weekends, building your watch list, staying open, flexible to the fact that the market can change. Anything can happen. We could have a new bull market here. We could have anything can happen. I'm open to any of it. I always try to stay super, super flexible to the fact that I don't know. I don't know what the market's going to do. I have a thesis. I'll put my chips down, so to speak, based on that thesis, but I want feedback from the market that my thesis is right when I do that. Okay, so thank you guys. Hopefully you made it through this video. I almost didn't make it. Marcus Smith at investors.com, 800-424-9033, and our Twitter handles, at Marcus Smith, at Zen in the Markets. If you're interested in, don't tweet that much, but I have thought about maybe doing more on both of these accounts, I guess is the best way to put it. Have a great weekend, and we will see you next week. Bye-bye, everyone.